only one analyst has upgraded BP since the leak began. He's sitting right next to me. It's Mark Gilman of Benchmark. Bloomberg ranks him among top analysts for his calls on BP and the oil and gas industry. And as I said, he's right next to me. Thanks a lot for coming in.
Sure enough,
Appreciate
Julie,
it.
it's my pleasure.
So, as Adam said, a lot of analysts have buys on BP already. But you're saying now that it's fallen to a point where it is looking like a good buy. Now, you heard Adam doing all the numbers here and the calculations. What's your calculation to arrive at this?
Well, Julie, our numbers are probably just a little bit different than what Adam was suggesting. We're suggesting that the loss in market cap, when you take into consideration the sector performance between then and now, is probably closer to a 32 to 35 billion kind of number. But when you look at that, you have to take into consideration working interest considerations, and so far as the lease itself is concerned, tax considerations, and in our view, present value considerations. All three of those factors would take that 32 to 35 billion and potentially raise it to a level that approaches $100 billion. And while I'm not prepared to go on record as to exactly what the ultimate liability is going to be here, I'm pretty comfortable suggesting it's not going to be of that order of magnitude. And thus, our change in posture on BP today is a reflection of our belief that the discount reflected in the shares as they're priced currently is excessive.
Well, the other companies that Adam called up a few moments ago, most of them are still in business. When you look at Merck with Vioxx, for example, Exxon obviously is still in business after Valdez. Union Carbide, though, is a company that's not around anymore. But you think obviously that BP can survive this and then some, has enough cushion to get through this.
Julie, I don't think there's any question about that. When you look at the balance sheet, which is not something that was specifically part of Adam's discussion, it's our belief that you could slap an additional $20 billion of debt on that balance sheet and have a debt ratio at the end of the year that looks something like 37%, which, it's above management's target range, but certainly not a source of any great concern.